here. So I think we are good to go. We should be live right now. And of course, my oven is beeping. Once again, hold on one second. We are live, but hold on one second, guys.
We are live, financially fit. Colton is taking care of his oven right now. Guys, welcome to Colton's live stream. He's
Got to make
back.
sure we don't burn down the house, you know?
It's been a minute since I've been on this live stream, man.
Yeah, man, we haven't gotten together in some time. So kind of get us up to date. What's going on?
Oh, man. First of all, can we catch up really quickly just before we get into the market and everybody's going to start coming into the live stream here? What's been going on in your personal life? I mean,
Yeah,
he's a new man. He's engaged. Congratulations.
yeah,
Truly,
man, thank you.
it's been an honor to kind of be on this journey with you, though, through YouTube, to be in the experience with you.
Yeah. So we get my fiance and I were getting married December 31st. So it's gonna be like a New Year's party. We got a wedding going on in Disney, so it's gonna be a whole Disney themed wedding. So yeah, it's gonna be pretty fun, man. Looking forward to it. It's been stressful and exciting all at the same time. But yeah, Disney knows how to milk that money, man. Maybe I need to be looking at buying some more stock in Disney. Boy, oh boy.
Congratulations, man. Everybody mark your calendars. Big news. And maybe it's time to invest in Disney stock. Although, we have Netflix earnings that came out the other week. And I don't know, there's some competition. We can surely talk about it. Guys, on my end, I have been actually now working hand in hand with Colton and bringing him onto the TipRanks platform. How are you liking TipRanks, first and foremost? Have you been using it?
Yeah, I actually use it a lot now that I'm kind of getting familiar with just scrolling through the platform, getting an idea of price targets. I really like that. Kind of insider trading, like who's buying it, when they're buying. I like all of that. Forecasts, analyst expectations. So it's definitely beneficial. And I got the link in the description for people to get in there and get a 10% off. So guys, it's definitely been a useful tool for me, and we're probably going to end up using it today when we go through earnings as well. So one of the earnings I'm kind of interested in reviewing is, I'm interested in reviewing Uber's earnings and then also Airbnb, just because the consumer shift that's taking place, I find really interesting that it's not about products anymore. It's about traveling and services. So interested to see kind of what happens with Airbnb's earnings after the bell as well. So a lot of different things shifting with the consumer and trying to stay on top of that as well. But yeah, no, the platform's phenomenal, man. I got no complaints. I actually might have you kind of show me any ins and outs that you like about it that maybe I'm overlooking. So
Of course, there's so many tools that we have. I just did a live webinar the other day for a few hundred people, and it was an honor to do it. I took over very recently as head of customer success, and so now engaging with our customers and really understanding the tools that are needed, on the front lines for the retail investor. And what was actually, I was very honored to be on that webinar and to be hosting it. But what I learned from that webinar was really where people are at when it comes to their thinking about the state of our market. And we always talk about the economic backdrop. And I think that's most important. I think how I typically go about investing is first taking a look at the macros before zooming into any stocks. And just based on where we're at right now, I mean, we can rewind a few months back to when we were talking about what Jerome Powell would ultimately end up doing with those interest rate hikes. The big question is now upon us again. What is Jerome Powell going to do when it comes to the interest rate hike come November? What is it? November 3rd, he's coming out with the announcement.
Yeah, so the meeting's the first through the second. I think it might be the end of it actually might be the end of the second or possibly the third. I'd have to double check. I got the calendar somewhere. But yeah, this week they are meeting, and it's going to be a 2-day meeting with the hopes or the expectation of a 75 basis point hike once again. And, it's unprecedented times that we're in the fact that these hikes, we talk about 75 basis points like it's no big deal. And these are record rate hikes that are taking place. A 25 basis point, a 50 basis point is a big move in markets. And when we're talking about 75, 75, and 75, it's just like it's unreal, and how it impacts, future bottom line growth for companies, the cost of capital going up. Obviously, it's going to impact consumer sentiment. Eventually, it's going to trickle down to everything that we use, whether it's credit cards or just any sort of loans. So there's this just trickle down effect that still hasn't taken place, that I personally don't think is going to take place until we talk more into the middle of 2023. And that's where I think we're going to have the best opportunities, probably going to be the beginning of 2023. And I think we start seeing some clarity possibly to the end of 2023 personally.
I would agree. I think it's a term I often throw around, one that I made up. It's not out there by definition, but emotional investing. I think we've seen a lot of emotional investing going on past couple of weeks, without a doubt. We had big tech earnings that we can talk all about, in this live stream. But last week was a very volatile week, a lot of emotions running high in the market. And I think, as we're now already seeing this week, we opened up on Monday with futures opening flat, and then the market opens. They dipped a bit, and today it looks like the same happened. And I think all eyes now are just on not only the interest rate hike itself, right? Because we're anticipating a 75 basis point rate hike. I think the more important takeaway from Jerome Powell come November 2nd and 3rd here is his tone. I think it's how, what the Federal Reserve is going to be doing in 2 months, in 3 months, and 6 months out. That's what I think a big focus for investors. That's where it should be right now, is his tone. Is it going to be like the Jackson Hole symposium where he comes out, he's very hawkish? Is he going to be more dovish? And with that, I think that's going to be more foretelling for our future, the market. The market is a forward-thinking vehicle. And so we now need to begin to think well into the future, into 2023.
Yeah, and I mean, I think the thing that I'm most concerned about is, people getting roped in kind of into the equation of everything is okay, everything seems good, but then the true trickle down effect takes place. I think we're going to see a possible relief rally if there is any sort of dovishness in his speech, and I think people are going to run with that just because that's what the market does. But if we look at what's going on with yields, the yields are telling a telling story here, man. The 3-month is inverted over the 10-year, and Ari, I mean, this has been the most accurate predictor of anything you could have asked for. I mean, if you really want to equate it, it actually called the pandemic before the pandemic even happened. So when we look at the 3-month to 10-year yield inversion that took place, look at this. This was before the pandemic happened. And it's been an absolute accurate depiction of history of when recession is going to hit. Where are we today? Well, we're inverted, and today's close will be a 4th consecutive day of an inversion of the yield curve of the 3-month to 10-year. So I find that to be no rush, relax. The yields are telling one story, and this nice rally, and if the Feds go dovish and it rallies even more, are going to tell a whole nother story than what yields are telling us.
Well, we've been talking about the yield curve now for, I think, our first live stream, right? This is something that we brought up time and time again. It's been an accurate predictor of a recession since 1955. I think it's only actually missed one recession, if I'm not mistaken, but since 1955. And so, yeah, you better believe this is the most accurate indicator of a recession. If not technically, right, we're in one could say, but a deep, deep recession. And I think that's also important to note.
So I think, the more I started looking at this, right, the more I started formulating every crash, every economic data that we digest is going to be digested differently as time goes on and we evolve economically. So one of the things I would say is that we are in a recession for the lower class or individuals that are on fixed incomes. We talked about this K-shaped recovery coming out of the recession, right? We talked about the K-shaped recovery. Well, all of a sudden we don't hear about the K-shaped recovery anymore. And I think that's exactly what's going on right now is we've had this K-shaped recovery, and within that K-shaped recovery, we're starting to see the lower half of individuals really be on the side of recession, really feeling the pain every aspect of grocery shopping, filling up their car, paying their rent,
Going to Disney.
electric bill. Yeah, no, not even going to Disney. I mean, how, it's like, so we don't hear about that story because unfortunately those individuals are not as forefront in the markets and political figures. So we don't hear the true pain that's taking place on possibly the bottom 20 or 30% of individuals, as far as people that income earners. And I think that's where the disconnect is with all of this recession talk. It's like you watch these guys that make $500,000 a year on CNBC saying, no, we're not in a recession because the job market's great. That's good. Tell that to the lady that's living on food stamps that can't go to work and her money's only going X amount so far right now. You're going to tell her that we're not in a recession and she's now, possibly having to look to move in with a relative because she can't keep up with the cost of living. That's horse crap. Okay. So that's where I get frustrated in saying that this is a different type of recession. So when people come on my channel and they're like, you don't know what you're talking about, we're not in a recession. You might not be in a recession. Trust me when I tell you the amount of inflation that we're dealing with, there is individuals out there that are in recession, even though the job market's strong.
Absolutely. Look, it's going to hit everybody differently, and I think at different times. And that's something, that we need to consciously as investors understand, because while we're not feeling the direct implications right now, down the line, we certainly will be. And I think, even so with midterm elections coming up, I mean, there's just a lot going on behind the scenes that painting that whole picture for yourself as an investor is pertinent. So taking a look at somebody who's maybe making below $50,000 or below the threshold that you're currently making, how is that impacting them? And then what political moves or political direction will that actually end up taking us in? And so we can start to see now, right? We have Biden speaking once again about lowering prices at the pump. Incredibly important. That's going to hit the energy sector in a certain type of way, especially coming into midterm elections. But again, who is he really speaking to, right? What's his demographic? Who is he trying to reach out to? And it is, those lower class, if you will, investors who may be out there, or the lower class populace that's out there, the base of his voters.
Right. Yeah, I mean that's the other thing we got to look at is some of the rhetoric that's taking place right now is just the midterm move here to get some votes, and it's unfortunate, but I guess that's just politics being politics, and so while that's all fine and good, some of the decisions that could have been made early on, as far as being more independent, reliant on energy here as a country, would have totally not even been a topic of conversation today, as what's going on with OPEC and what the cost of fuel has been. So there's decisions that have been made by political parties pushing the green movement, which, I'm all for green, but there's a right and wrong way to do things. And now we're paying the price for that, and or going to probably pay the price for that as we start hitting the winter months here. But yeah, it's just interesting times. So give me your time frame of when you think that we start getting out of this or getting some clarity, because really quick, what we're starting to see with earnings, and you brought it up earlier, is that earnings are all over the place, right? We have, the ad revenue that's completely slowed down versus, some of the other companies that are completely dominating. Obviously it's the defensive stocks, the Coca-Colas, the Johnson & Johnsons, the McDonald's, absolutely
Thank you.
killing it.
I just want to I was there 6 months ago. I was already there 6 months ago investing into Johnson & Johnson and my defensive stocks as a value and dividend investor. But I will say no more in regards to what I was doing 6 months ago. It's about what's happening right now, and it's about the moves that are being made now in order to best prepare myself, perhaps yourself, for the future. So with that said, look, one of the dominating questions that came up over and over was, on my webinar for Tip Ranks, when do you think we're going to be in the clear? Now, I would love to sit here and share with confidence that I know, in 6 months, in 12 months, we're going to be in the clear. The reality is, I don't know.
Yeah.
And
no. All right. Nobody knows, because the problem is these hikes they're going to take so long to get through the system and for it to impact the economy, that by the time that we actually start feeling the second, third, and fourth hike, it's going to be the end of 2020. I honestly think, and I've made this argument that we could possibly be in some sort of secular bear market, and I know that freaks people out, but that's basically 10 years of no to negative gains. And within that, you could pick good quality companies still and still outperform the market. But I think we're so reliant on the top 5 companies for the last 10 years to carry the weight of our retirement plans, to carry the weight of all of the indexes, that we've really let go of companies that still have strong business models, that have resilient revenues, that now are going to be the ones that may carry us. And
Well, also,
unfortunately, they don't weigh as much.
do you think the masses of the investor has changed at all? I almost think, right, we're getting a new type of animal out there when it comes, and we talk about this one as well quite frequently, right? When you get your gambling like mentality with the quick apps and the fast triggers of investing now, investing into the Palantirs now. And then we have YouTubers out there who are sharing with us right now, hey, this is the stock you need to look at. It's down, it's up, it's everything in between. I almost think we have a new investor that's out there, which is dangerous to begin with. But, do I think a recession is going to hit us? Yes. Do I know exactly when and how? No. Therefore, it's best to prepare yourself right now while things aren't as nil as they may be come the next 6 months. And, that's kind of the mentality I had 6 months ago. And while my portfolio is currently down, it's not down as much as some of these other guys out there on YouTube or investors. And I see through, right? You can look on TipRanks as well. I don't know if you're familiar with this tool, but what other investors are doing on TipRanks. And you can see what they're investing in. And you can compare your portfolios. A very interesting tool. But what I've realized is my portfolio is not, right, as hit as some of these other portfolios.
Yeah, and that's because you are more of a value investor. You're not looking so much for the hype and the names. You're looking for proven track records. You're looking for companies that have proven cash flows, dividend kings, dividend aristocrats. So you're looking for companies where they've already weathered these storms in the past. Now, maybe the storm's a little bit different, but they already have kind of the blueprint and resilience in their revenues to kind of get through it. And there's a lot of companies right now that haven't, over the last 10 years, dealt with a tightening process quite like this. We'd have to go back to 2008 to even get close to what we're dealing with here. And there's so many companies out here that are not knowing how to handle this. And there's going to be a lot of companies, mark my words, that do go under, that are going to catch a lot of people off guard. And that's just the fact of not knowing how to handle when the cost of capital actually goes up and money's no longer free. And not only is money no longer free, but the consumer is now in an area where they have to really focus on where their dollars are going. While yes, they are spending on traveling and services right now, that will come to an end probably abruptly, when I'm guessing once again beginning of 2023 is when we're going to start seeing it.
Look, it's also interesting to know that the consumer is well capitalized right now, and we, on top of that, we also have the labor market that has been extremely resilient. And so we think this is good news, which, eye to paper, yes, it is. But looking down the line, and especially with what the Federal Reserve is looking to do, right, the real market mandates right now comes down to two things. And we're looking at inflation and we're looking at labor statistics, right, the data in the labor market. And so what is that telling us? If the labor market is still really strong, the Federal Reserve isn't going to pump the brakes on the interest rate hikes. This is not good for growth-oriented businesses. And that's just something to watch because, again, consumer may be well capitalized. The consumer may be spending right now. But are we really looking into this economic backdrop of ours and being forward thinking? That's the key.
So I heard something interesting today, and I don't know how true this is or how this is measured, but let's say that I signed up for Uber. Okay, let's say I have a job already, like I work a day job, but I sign up for Uber, I signed up for Lyft, and I signed up for like Uber Eats. They're technically saying that that's 4 jobs that was created. So
yes,
how much smoke and mirrors are coming down to this true job market of, is this a job market that's based on a bunch of that kind of stuff? Or is this a true strong job market where these job markets are going to, because at the end of the day, the job market's going to come down to how strong the consumer is. If the consumer's weakening, 70% of our, economy is based on consumption, then the job market's eventually going to come down as well. And so as the consumer weakens, like there's a lot of smoke and mirrors with this job market.
I will say midterm elections, and I think, there's a lot of work being done in order to bolster the Democrats. It's, I'm just shoot straighting here and give you guys exactly that. I think we're seeing a lot of news outlets, right, refraining from using the word recession, even so right now. But
100%, 100%.
Any gig work is not an accurate indicator of true employment. It's just not. It's not feasible for the long term. It's not feasible for the interim. But yet, yes, it is all being factored into our latest labor market reports. Shamefully.
So we had a question on here. What's your thoughts on AMD? I've had it up here for a minute, but so I guess AMD is reporting today. Airbnb, I think, is reporting today. I believe AMD is reporting today. I'm pretty sure they're reporting today. What's your thoughts on AMD's report?
Semiconductors, it's all going to be big. Is it going to be big now? I don't know. I look at, again, I'm a big macro guy. So I try to take a look at what's happening right now in regards to the Chinese, right, and the US and the tensions that are rising, as well as with Taiwan. And I don't necessarily know if we're going to have, right, a huge run up when it comes to semiconductors in the interim. But I think, if you're investing for the long term, absolutely. It's worth it adding to your watch list, perhaps an investment. I just talked about on my personal channel, Taiwan manufacturing.
Yeah.
Semiconductors as well.
Yeah, they reported, and I think they got hit pretty hard too. I mean, there was only one semiconductor that got hit. Was it and their main focus, and I'm forgetting the name of them, but their main focus was actually automotive. So the automotive chip makers have been holding strong, but once again, how long does that last? And it's these headwinds for the chip makers, I just don't think are going away anytime soon. They got so much supply right now. And it's just getting ugly. Then you obviously have political tension, and then you have companies like Micron and Intel coming in domestically and really spending to develop here. And while that's all fine and good, that's definitely going to impact, a future growth here until they get supplies back up, until they get, inventories to a normalized level, and until the facilities are up and running. There's a lot of spending there. And so therefore, once again, I hate to say it, but it's just, I think they're one of the biggest opportunities when it comes to, easy, I don't want to call it easy money, but easy growth when we think about AI and how much we're relying on chips, that it's absolutely not going anywhere. It's coming down to which ones do you pick, how good is the balance sheets, and how much in demand is their chips going to be. And if you could figure that out, then yeah, I think this is a great accumulation phase, because it's going to be a few. Yeah. Drop a line in the in the chat here, and we'll get on that.
If you have the inside information, I mean, share it.
But I think
to your point, go ahead.
No, just to get to the question, for as far as AMD goes, I tend to think that, there's been so much bad happening that maybe any sort of good news will give it a short-term pop. I just don't necessarily think it's going to be a long-term catalyst that's going to drive the stock back up to $180. It's at $59, and this is about what I think is probably close to fair market value for a company like AMD, trading at 26 times earnings here, and earnings are unclear. So,
I think, again, I never really give the stock advice to buy this stock now or, invest in it today because X, Y, and Z. But I will say, when it comes to being an investor with insights, it's really going to come down to a company that has a very strong brand name. I think that's incredibly important. A good reputation, right? With a very strong management. Most importantly, is a well-capitalized business.
Yeah.
Can't stress that enough. I mean, the data just doesn't lie. This was on one of the Tip Rank shirts, so I can't take the credit for it. But, we have a shirt with a slogan on it that says, "Cut the bull, trust the data." And I
Yeah.
and I love that because the numbers just aren't going to lie to us. You can't make up the balance sheet.
I mean, I think 100% correct. When we think about where we are in the economic cycle, liquidity is a problem, right? That's why you're seeing Kathy Wood's ARK. Let's just take a look at ARK really quick. Um,
Tanked.
it's just it's in bad shape. But why? The question is not is it in bad shape, guys? You have to ask the question why. Why is ARK tanking? You know, anybody can look at a chart and be like, oh, okay, it's tanking. Well, that's great, but let's give reason to why it's tanking. A lot of the companies in her portfolio are quote unquote innovative companies. They do not have good free cash flows. They do not have good balance sheets. A lot of the times they're diluting on stockholders to maintain some sort of equity because they're burning capital to grow their top line. So, what happens when interest rates rise? The cost of capital goes up, and these 30% margins that they were hoping for are now going down to 15 and 12% margins if the company can even stay afloat through a recession. That's why we're seeing the repricing in ARK's innovative ETF. If we maintain low interest rates, maybe a lot of these companies had a shot. Listen, man, if it wasn't, Tesla was on the verge of bankruptcy at one point early on in their career, and look at what happened. They turned it around. So there are turnaround companies, but it's really hard to pick the winners and losers in all of it until you really start seeing it flow through, as you said, on their balance sheets.
Yeah, look, I think, when it comes to Kathy Woods and her portfolio, she invests directly into companies that are disruptive, disruptive technologies. And what's right now the scariest thing you can possibly invest into? Disruptive technologies that require a lot of capital for growth. And this actually, just before we cover, I see you're pulling up Airbnb, but this brings to mind Meta. I mean, honestly, now I will throw this out there. I do have a handful of shares of Meta, but I'm not investing anything more. It was an investment that I had and I kept within my portfolio, and I'm going to continue to hold it. Now, what's interesting is understanding this when it comes to Meta. We're talking about a company that went in the early 2000s when Meta was Facebook, and there was no limelight on Mark Zuckerberg, no media attention, no investors that were breathing down his back and watching his every move. He was able to put capital where he needed it to start this thing called Facebook. And it was the newest, the hottest, the latest, the sexiest thing. And what do you know? It blows up, it revolutionizes our world. Now, that didn't just happen for Meta. That happened with Google, with Microsoft, with Apple, with all of these big tech companies. And so sometimes I'm listening to what people are saying and I'm like, I got to give Mark Zuckerberg some credit on the stones this guy has, because to
Yeah.
have this amount of heat coming his way, but remain steadfast in a vision that he has to continue to change the future. I mean, I think that's worth noting. And so we may see him burning a lot of this cash, and it's disruptive technology that we're talking about here. But the big question is, what about 10 years from now?
Well, I think, and that's like the point, like I feel like a lot of people thought I was being a little bearish on my meta analysis that I did in my last video, and that's not the case. It really comes down to your perspective on if you think the metaverse is going to add any sort of growth in the next 10 years to the top line of Facebook or Meta in general, then it is an absolute buy around $100 to $120. Absolutely, you don't even have to think about it. If there is concerns that you'll never see that money get an ROI on it, then you're looking at a $75, $80 stock, in my opinion, with still upside that, their free cash flows will eventually come through, but that money's gone. They're not going to ever see a return on investment in that capital. But for me, I tend to think like, yeah, you have to be a little out there, because think about this, man, 15 years ago, we would it blow your mind to think that people would now communicate through phones but not use the phone to actually talk, and it would all be text? Like, or all video chat? Like, how
I
many
mean, look,
people how many
I
people
was
actually use the phone for the phone?
I
Like,
remember
nobody.
my first brick of a phone.
Yeah. Dude, I
And
had the flip
I never
phone,
saw this.
like,
This is the coolest thing since sliced bread. And now I'm holding this device, and it's baffling for me to realize how far we've come in such a short amount of time. Now, my question honestly is is the metaverse really going to be something? And do I see myself using it? And right now I'm answering honestly and saying I don't see myself using metaverse technology. But when the world gets there, I'll be right there first in line.
So here's an okay. So I'm gonna throw this back because I actually, the more I'm starting to talk about this, the actually more bullish I think I'm getting on metaverse, because I actually think the opposite now, and I'll tell you why, Ari.
Here goes your whole portfolio into meta.
Dude, I'm about ready to jump in before the bell rings. What are we at? We got 9 minutes. I'm gonna throw it all in meta right now, guys, live on the stream. No, but think about this, right? Everybody works remote. Well, a lot of people work remote now, and a lot of people don't have the ability to communicate with their family in the sense that they can see them and sit down with them. And don't you think that that brings an interesting dynamic 10 years from now, that you have a headset where you can actually sit in the same room with your mom or sit in the same room with your dad and be across the country and have a 15, 20-minute conversation? And it doesn't sound like today I would say no, but I would say in 15 years, when everything is pretty much, we can do everything remote because AI is taking over, maybe it does make sense that to still keep that intimate connection is going to be done through some sort of AI. Because I look at your situation and I'm just thinking, like, if it was affordable, right? If it was $200, $300 to have the VR set and have the setup, not anything astronomical, but affordable, right? Would you use it once a night to check in with your family?
Yeah, I'm the hardest sale in the room. And I'll tell you what, why not FaceTime? Why not
Because
Zoom? Why not FaceTime? Why do I have to get into the metaverse and I'm an avatar, right? That's my question.
I think you're right. You could use the FaceTime, but does the FaceTime doesn't give you the intimate connection that a 3D, as if it can get realistic, the 3D effect of actually sitting next to a loved one maybe can. I don't know. I'm just throwing it out there. Like,
crazy to me.
it is crazy, but
I have running through my head is I gotta feel the touch, right? Like
they say it's so you almost can start feeling and sensing certain things, like so like that aspect, it makes it interesting because, like, 15 years ago, look at how we're communicating right now, doing a live stream with people all over the world right now, right? Like, who would have thought it?
Right.
So you can't say it's not going to happen, because evolution has showed us that it does happen. Is it going to be meta? I don't know.
Something big. And while I may not be like the one pioneering like an Elon Musk type of frontier, right, hoorah guy to say get behind Meta, I think it's something. I don't know what exactly it is, but I was sitting there, as this little kid with that brick phone, saying, well, this is awesome. This is something cool. And all of a sudden we get now, right, an iPhone, which, by the way, you're talking about affordability. $300, $400, nothing in comparison to Apple's iPhone, still $800, $900.
Yeah, and that's going to be
spend.
That's going to be the hurdle, I think, is going to be getting the cost to a point where most people can digest it, But you think about, like, I remember when, like, PlayStation first came out and it was like $399, like, back in the day, and I was like, holy crap, that's a lot of money. And now it's like, I don't know, it's like people blow that every day. So I guess it's all relative, but yeah, I think the cost structure is going to be interesting, to see if they can really get it to a point where people can digest it and willing to pay it, and it brings that much value into people's lives that they
Look,
use it.
I think the sale is really going to come in from how well they're able to sell a guy like me who does not feel that he needs an avatar, to get an avatar and to jump into a metaverse room or whatever may have you. Why is that going to be relevant for me? And I think if you could sell a guy like me, you could sell the masses.
Yeah. I mean, the crazy thing about Meta is, like, what people might not see, and they're just seeing the stock price go down. If they only spent half the money that they're spending right now on metaverse, if they can cut the spending in half, The stock is dirt cheap. It's absolutely dirt cheap. Because you're figuring, Meta's trading at like 250 billion, I think, roughly. Or let's actually take a quick look at what their market cap is. But their free cash flow would be about 3 to 4 billion a quarter.
252
Times,
billion
yeah, times,
market cap.
yeah. So like if you look at it from a free cash flow standpoint, they are free cash flowing without spending on Meta, a significant amount of money. So if they could cut that in half and have 4 or 5 billion of free cash flow, just keep simple math of 5 billion over 4 quarters, that's $20 billion, a year. They're only trading for a 12 or 13 free cash flow to market cap. That's like the cheapest out of all the mega tech.
Also,
So it's like,
to throw this wrench in the mix here, if we go back 8 months, 9 months, maybe, I'm trying to think back to when I was still in Manhattan, having these conversations about the metaverse and new technologies. But Facebook at that point was still, I mean, we were kind of just coming out of 2020. Businesses were trying to ramp up advertising, and Facebook had more advertising dollars coming in. And so right now, as businesses are once again preparing for what's to come, a recession, again, the allocations in their budgets are being transitioned elsewhere. And so now we're seeing, again, Facebook comes out with their quarterly and they're way down, but yet they're spending cash. And I think that, I mean, of course, it's tremendous fear, but that's what the picture matters. Painting this picture matters. What's going on behind me, right? If I'm making crazy moves, hand motions, and I'm all excited, you guys are all focusing on me. But like, I think it's a video out there, like a GIF or whatever it may be, but there's like a clown that walks behind somebody.
Yeah,
and they
in the background.
The clown, and everybody's like, no, I didn't see the clown. That's kind of what's happening right now. We're so focused on the now today, we're missing out on what's back there.
Well, I would say this. I think the market is punishing all companies that are spending, whether it's good or bad. Because you look at Amazon, right? And I forgot who was on the live stream with me on Amazon. I was like, listen, if Amazon breaks below 102, that's going to be interesting because like the next line of support's basically between 85 and $90. And it broke up above 102, and I was like, it's probably going to go back. But I think today it broke back down. But anyway, long story short, Amazon's another company that's spending, right? It's spending for the future, and it's getting hammered. Facebook is spending for the future. It's getting hammered. So it's like these companies that have been kind of the flock to safeties and the big names and the ones that actually led us to this 10-year bull market that is just unbelievable are the ones that are absolutely falling off of a cliff because they're spending.
Man, I think a really interesting one. I mean, look, I've been buying Google, but I did buy Amazon. I'm going to throw that out there. It dipped below 100, and I just threw in. I made 20% of a return off of a Delta Airlines trade, and I took my capital and I just threw some money into Amazon. Just going to hold. But below 100, I mean, these prices we haven't seen. We haven't seen these prices.
We haven't seen these prices, I think, since 2019 or pre-pandemic. These are all pre-pandemic levels. And so, but here's the thing, Ari, is like people assume because something traded at $200, like, okay, I use Facebook as an example because I think that's the easiest one, right? You look at something like Meta that traded at almost $350, $400 and now is at $96, and you think it's a steal, right? But is it a steal? Like nobody knows, because how much more are they going to spend? Are they going to lose more because their revenue was down 4% and they're spending $9 billion a quarter? Like if that keeps up, then it's an expensive stock, like even at $96. But if the ship gets righted, then it's a very cheap stock. So we're in this inflection point with a lot of stocks right now where they look cheap from a price point, but from a valuation standpoint, depending on what they're doing with their capital allocation, depending if they're losing top line revenue, like Intel. God, dude, I think that's another great example. Intel looks like the cheapest stock in the world, right?
Every dividend investor, by the way, is talking about Intel.
Yeah, it looks like the cheapest stock in the world. But what do we know about Intel? They're losing market share. They're spending a ton of money right now. And the future is very unclear for Intel. So is it a cheap stock? Well, if all those three things don't change, it's not a cheap stock.
I stay away from Intel. I've stayed away from Intel. I hear, as a dividend investor and someone who connects frequently with other dividend investors on YouTube, I have strayed away from it. I have shared my 2 cents about Intel. As you said, it's losing market share, and that's been a primary concern for me. I mean, that's something that I'm always thinking about. How is this business relative to other businesses within the industry? How are they doing?
Yeah.
What's their health look like? And
Yeah.
Intel just, I mean, it hasn't proven itself to me.
It has it, like, even though, so here's the thing about Intel can get it right because they have a crap ton of revenue. Like, even when you compare their revenue to AMD, like, let's just like while we're here, and I want to go over, I'm going to throw up Airbnb in a little bit here just to
We'll
kind of,
get to it. We'll get to it. Yeah.
but like, okay, so their top line revenue growth has went from $70 billion a year to roughly the trailing 12 month is 73 billion. Okay, now let's compare that to AMD. So $73 billion of top line growth. I mean, top line of
You
revenue,
said million, right?
billion.
Billion. Okay.
Okay, 6 billion to 21 billion. So it's literally it's doing 4 times the amount of revenue that AMD is doing. So the revenue is there. That's not the problem. The problem is recapturing the market share before, AMD takes
Before
50%.
AMD.
Yeah, before AMD takes 50% of it. But like, when you put it in perspective, like, AMD is a peon to Intel when it comes to looking at a revenue standpoint. But you would never guess that looking at just the surface level stuff, like, oh, the stock price is going up, it's a $50 stock versus a stock that's about ready to go bankrupt. Dude,
Right.
it's just, can they get it right? If they can, it's friggin' cheap. If they
Well, that's why I
can't,
say that a company is well capitalized. That's amazing. But again, it does come down to other factors. In my opinion, is leadership and management is a key factor. I think if I'm going to invest into a company, I want to be able to very comfortably, honestly sit down with the CEO or executive and have a cup of coffee or tea and talk and understand their vision and have them relay all their ideas to me so that when I'm looking into the future, I can be confident in sharing, yes, Apple will be here, Intel will be here, and Microsoft will be here, any of these stocks, right? Strong management is essential for me in order to actually proceed to invest. Likewise with a strong brand name. And those are two areas which I'm not entirely sure Intel checks the boxes for me.
yeah, management has been a question for an extended period of years. And I think you're bringing up a good point that, it's management you have to look at as well as the actual company fundamentals, because that's the one who's steering this ship, right? And that's what I'm like saying. You're basically, if you're buying Meta at these levels, you're betting on Mark Zuckerberg to do something right, because even if Meta fails, there's something else that could come of it that ends up being an acquisition, maybe, that pays way more than anybody ever thought. So yeah, you're banking on management as well when you're talking about the aspect of buying into a company, especially companies that have fallen off the way that they've fallen off. You have to put your money somewhere before, because otherwise it's a value trap, right?
Well, look, you know how many memes and pictures and now that I'm overseeing, tip ranks to social media, I'm like constantly, I haven't been on social media for like a year, right? In my personal accounts, but I've been on it through a business lens, literally just digesting what people are talking about when it comes to businesses. And something that I've been watching pretty closely is how people are talking about Mark Zuckerberg. And honestly, it's pretty frustrating to see that, when things are hitting the fan, if you will, Mark Zuckerberg loses his support. And it's because, yes, he's burning cash. He's not paying enough attention to Facebook. Just stick to Facebook. Maybe if they do a rollout for metaverse. But here's the reality. Did we believe in Mark Zuckerberg in the early 2000s? in the mid 2000s, 2010 to present. And the fact is we did. And then I'm looking at a guy, I know out of all guys, I'm going to bring up Jim Cramer right now, but I'm going to preface with sharing the man went out on a limb here to apologize on TV about telling people to invest in Meta. But I don't know. I think maybe Kramer should have stuck to his guns if he really foresees that Meta could be something and that Mark Zuckerberg is still a somebody. The guy is looking to make a massive, massive push into the future. That is not an easy task. And I would challenge anybody behind the screen of their phone tweeting, oh, Mark Zuckerberg, this is the guy that's running Meta, going to run it to the ground. Go run Meta. Go take on the tasks that this guy has taken on, and let's see how you perform. Monday morning quarterback is easy. The reality
and he's spending to get it. He's spending to get it. He's spending to get ahead of competition. Listen, where we are today is not where we're going to be 2 years from now. And that's what he's starting to say is like, listen, I'm losing market share to companies right now. What can I do to make sure that 5 years from today, this is not even a conversation that anybody's touching me? And I think that's what he's banking on, the evolution of social media being more of an AI-driven type of mentality over anything else. And I think that's what it is. Oh, by the way, we're getting a pretty big sell-off in Airbnb here, down 9% after hours. So possibly a pretty bad earnings report. I don't know.
We can check. I mean, look, I wouldn't be surprised if it's not a great earnings report. I think demand in travel has gone up a bit over the last few months, but there's nothing like insane right now in regards to travel.
Well, if you look at what Uber did, Uber had a pretty substantial revenue growth, and I was going to go over Uber earnings at some point, maybe in the next few days. But the stock-based compensation is it reminds me of Palantir, the way they do their accounting. And it's just like the stock-based compensation, adding it back in. So it looks like they have free cash flow, which they, essentially they can do that. But they lost 60 cents, 60 cents a share, which was well above consensus 17 cents a share, but revenue came in like huge, like they killed revenue. So the stock was up 13% today. But let's take a quick look at AMD as well, see what they're doing.
Look, it may also just be the case that investors across the board, we're all looking at the Federal Reserve at this point, and we're seeing what growth stocks, where they're at, and people are getting more nervous by the minute, by the hour, by the day. And but we'll have Jerome Powell coming out soon and his remarks coming out soon. And I think, again, dependent on his tone, these stocks, Airbnb, AMD, they could shoot right back up end of week.
Yeah. Yeah, I mean, you never know, what could happen. There's always an overreaction either one way or the other. And then I did a video on SoFi today and I said, SoFi normally gets a massive spike and then sells off. And PJ watched that video and he actually dropped a line here. And he watched that video today. And what happened is SoFi opened up at like $6.50 and it closed at $5.50, and I basically said that's the normal move for SoFi. But I think they're doing everything right. There's definitely still a lot of risk with it, but it seems to be like they're doing some pretty good things here. So
have you jumped in on any stocks? I mean, the last we were on a live stream, I know you were cash heavy. I presume you're still cash heavy, and
I bought Gilead Science around $60, and it's at $80 right now. And the problem is I've been selling cash secured puts that are probably going to get called on me at the end of November. So I'll still realize a pretty good gain on that one, but yeah, I collected a dividend. I'm basically going to make 20 something % on that.
Are you becoming a dividend investor?
No. I was big on Gilead Science when I compared to so I look for value in a lot of different ways. And what I noticed is when I compared Gilead to its peers, it was extremely, extremely undervalued. All analysts had them doing negative revenue growth. So the stock was depressed. And I'm looking at what's in their pipeline. and they're on the verge of getting like this breast cancer treatment out, like getting it approved. It's like through a third phase. They obviously had great numbers. Dude, they absolutely murdered numbers. Like way more than I thought they were going to. I thought they were going to beat, but not like they did. And now the
All we
stock
have
went
to
from
do at this point is go on to Wall Street Bets and just exactly what you're saying. Just put that in, and boom, we'll run this stock up.
dude, I'm telling you, man, like that to me was like that was an easy safe haven because with healthcare, it's more of a safe play, kind of get your dividend. Healthcare is not going to have huge volatile moves unless if they had something, unless if the price baked in that they're going to get an approval on some sort of FDA approval that doesn't go through, then all of a sudden the stock's down 15 or 20%. But if you're looking at healthcare just from strictly the lens of like a Johnson and Johnson or a healthcare where they don't have anything in the pipeline, there's nothing crazy. The growth rate with the pandemic, the amount of cash on their balance sheets, they're competitively, they're all pretty undervalued when you compare to the market as a whole. So for me, it was like healthcare is a no-brainer to be in. Now it's getting a little overstretched, but like we're talking about the beginning of the year or an end of last year, healthcare was super, super cheap, man. Like super cheap. Whether Johnson & Johnson was one of them, Gilead was one of them. I felt like Pfizer was getting a little too, it was too much. Pfizer was too much in the news and too many people were jumping on it because of, they were just a front runner of everything. So I stayed away from them. But the ones that kind of took a backseat, Bristol Myers Squibb had some opportunities throughout the year last year. Those
Bristol
companies
Myers
to
had a
me,
lot of opportunities last year.
yeah, like
Silent
it's like
killer.
those companies were like stupid easy. Just you don't have to stress about your money. I like you said, I like to be able to sleep at night. Dude, those companies will let you sleep at night if you're buying them at the right price. And they were super cheap last year when everybody was jumping
Gotta
on the
tell you,
bubble.
man, I've watched friends, people contacting me at work, YouTube, and I'm sleeping nicely at night. And I know there are people out there who are constantly looking at the market with all of the volatility. The only thing I'm saying is why not head to value stocks? I've been doing this 8 months ago, 1 year ago. I've been saying the same stuff over and over again. And I'm happy to see people jump on board with value stocks now, but the real and ideal time to have invested in a lot of them, we
Was
missed.
last Yeah, it was last year. Was last year when everybody was pumping up Palantir, when everybody was pumping up, all the SPAC deals that were happening. That was the time to accumulate value stocks, McDonald's, Coca-Cola,
Do you
Bristol
know
Myers
how
Squibb.
much heat I took because I went on to some channels across YouTube and I shared Johnson and Johnson's a stock right now that you'd want to have in your portfolio to buy at these prices. It's never going to be, in my opinion, below, I'm sorry, under fair value. It's not. It's a fair value or above value type of play, and that's the way I look at it. Now I'm willing to pay the premium, but at the end of the day, where is Johnson and Johnson today? And the people that gave me the heat, silence.
Yeah.
And I'm
Yeah.
collecting the dividend, and I'm still
And
growing that position should Johnson and Johnson come back down.
yeah, and the position has done fairly nicely overall. I'm actually trying to pull up their earnings and it's like just circling me around right now. So I don't know what's going on here.
It could be a minute maybe to upload.
Yeah, I think they probably don't want anybody to see it, and that's why the stock's selling off. They're like, we don't want anybody seeing this garbage.
We're just gonna hold off a malfunction in our computing systems.
Yeah, if anybody knows what Airbnb did in the earnings, drop a line in there. I'm not seeing anything on their site, but I know the stock is selling off. Looks like AMD's fairly, a half a point down. Nothing crazy. So it looks like the article came out first. Looks like they took a hit on revenue due to the strong dollar.
Let's see. Revenue of 2.88 billion beats by 30 million.
And that's a pretty good beat. Net profit rose 45.6% to
look, I'm going to
1.2
say
billion.
this, and I'm going to say this over and over and over again. And I said it in the webinar. I'm going to say it here. I'm going to say it in my channel. I'm going to say it in the next webinar I do, at work. It's very simple here. It's the same thing we've been looking at when it came to Apple, when it came to Microsoft. These companies hit and beat expectations, but what happened? The stock ran up and dropped. Why? Is because earnings are a thing of the past. Earnings are reflective of the previous quarter. What is pertinent right now is one thing and one thing only. It is our future. Is a recession going to hit? What is going to happen if a recession hits to Airbnb stock? That's the big question.
Well,
And so
so the big thing is guidance though too. So it's like there's a lot of companies that if they can give clear guidance and positive clear guidance, they've done well.
exactly,
The
exactly.
the guy a lot of companies right now are not giving guidance because they have no friggin' clue, and that's why we're starting to see some of these stocks kind of flip to the wayside here. So I'm wondering if with
Look, man,
Airbnb,
no one wants to look like an idiot. No, right? And you got to be really careful with what you say. Um, I learned a massive lesson about 60 minutes and 1 hour ago. Look, just be clean and clear with your messaging and your truth, no matter how much fear you may be in. Why? Because at the end of the day, investors, when it comes to the stock market, they're looking to you for guidance. And if you don't know, I think in this type of market, it's okay to say that. It's okay to say, I don't know in 6 months. Take the little bit of hit on a stock, but the value of the company right now and the value of the company of where it may be and can they make it through a recession? That's key. That's pertinent. And that's gold. But the honesty is key.
yeah, I think the consumer being, the consumer unknown, the consumer unsure what the consumer is going to do is definitely going to scare a lot of companies, and that's why we're starting to see the run up in a lot of Kroger. I was trying to buy Kroger before the Albertsons deal,
Are you sure you're
and
not becoming a dividend investor?
Kroger is on the verge of becoming a growth stock that pays a dividend. Because they're going to be, if they can close these deals with Albertson, I think the stock is going to tank right off the rip because, the people are going to think they're overpaying for Albertson, blah, blah, blah. But that's going to be the opportunity to buy Kroger because that's going to essentially that should open up their margins, and it's going to give them a bunch of new locations without too much CapEx. So I think buying Kroger on this big dip, if the Albertson deal goes through, I'm really interested in doing that. And if we have a market crash, I'm really interested in buying Kroger long
Buffett
term.
was all over Kroger. You should pull this up.
Yeah.
The tip ranks. You take a look at the smart money, what they're doing. This would be interesting just to see right now.
Let me see. I got it pulled over here.
Because even insiders, right? Taking a look at what insiders are, that would give you great insights. Talk about learning some of the tools, right? Just based off of that theory alone, if you want to go and see what insiders have been doing, they obviously know what's to come what's on the horizon, the confidence in a deal on an acquisition.
Yeah, and it's like, it's the opportunity of people misreading it is what I like about it. So, for me, I'm looking for the link here.
Guys, if you haven't already, go ahead and click right on the link in Colton's description. It's in your description, right?
Yeah.
And join him on Tip Ranks. I mean, the tool we're about to show right here, phenomenal. Insider trading, you can take a look at what some of the executives, the officers of the company, and major stakeholders are doing. That's key. They have the inside information that all of us would love to have before an investment.
So I'm going to roll it over here. So right now you have a price target between $43 and $58. Personally, I was trying to get it it was in the 30s recently, and that's basically where I was trying to get in at, was a mid 30s. With the Kroger deal originally, I mean the Albertson deal talked about it drove the stock price down, and I thought that was a great buying opportunity. As far as insider trading goes, SVP's buying it up the last month. Doesn't look like there's been a lot over the last few days, but if we go by amount, I mean, 8 months ago, $6 million purchase, 8 months ago, $6 million purchase. And these are obviously big companies, but SVP is the biggest one on
Do
there.
me a favor, hover where it says transaction.
Oh, these are cells, yeah.
Just above, I'm sorry, where it says roll, and then above that, there's a drop down. It's a little blurry on my end to see, but it does say transaction right above.
On roll, I'm not seeing
Go,
that.
go
No.
one above to the
Oh
drop
yeah,
down.
yeah. Transaction. Yep, yep.
Excellent. Now just check off informative buy and sell. Guys, an informative buy or sell is when somebody makes an investment move with their own capital. What
So
do we got?
it's actually been all informative sells, believe it or not, over the last. But
Interesting.
these are older though. These are 8 months ago, 10 months ago. I mean, looks for me, I like the deal getting done because with Albertsons, they have their own internal brands, which is going to allow Kroger to take over those internal brands and have them in their own in all their stores, and that should grow their margins. So that's why I was liking. There's a
When,
lot of reasons why I like the deal.
when is this deal supposed to be effective?
It's unknown. So supposedly, it's going to take a while. It could take a year or two because the way the administration works and conglomerates, and they don't want mergers and acquisitions as much as they used to. So there's a lot of things that are forcing this to possibly not go through. But if it did go through, I really like the deal for Kroger long term.
Well, I mean, look, what we just saw, right? No insider recent sells. That's a good sign. Sometimes
Oh
no
yeah,
sign is a
nothing.
good sign. And just to
Yeah,
share, it's not always about an informative buys and informative sells. It's when is the sale actually happening?
yeah, and it's a strong, steady company. I think it trades for a little bit of a premium right now, I would say, but it's a strong, steady company. I mean, they're not going out of business. The whole goal for them is to become a competitor to Walmart, right? Like that's what their mission statement pretty much is. They want to be, they want to be in talks of Walmart.
You got to feel some pity for the Walden family. I mean, what everybody's coming after them: Target,
Yeah,
Amazon, Kroger.
yeah. It's they definitely got a bullseye on their back. So. So I'm just like looking at the kind of this is like more promotional stuff for Airbnb. I like to look at the actual line item, like the actual 10 quarterly
Item,
report,
yeah, yeah.
but I don't see it. This is all kind of here we go. All right. So, revenue, nice growth, ending in 9 months, going, I don't know if you can see that. I'll make it a little bit bigger. Going from 4.4 billion to
I'm blind as a
6.5.
bat, so
It's tough to see too on here. So, they're definitely having good revenue growth across the board. Cost of revenue is it's a big chunk up.
Again, keep in mind the conditions, all the conditions right now. I mean, none of this. I'm not too surprised at how earnings are coming out across the board. Just to be fair with the economic backdrop, it's like you got to factor it all in, and whatever companies are out there, whether they meet expectations, don't meet expectations, some of these actually make sense according to the storyline.
So a couple things here, like, the diluting is is one thing I've talked about with this company. It's not a lot, but it's just steady diluting. It's going from 621 to 638. It's actually at six. Yeah, it's at 630, 638. Yeah. And then stock-based compensation.
It's
676 million stock-based compensation. I mean, I want to see what their free cash flow was really quick, and then I'm going to let it go from there. So net income, in 9 months ended in 2021 went from negative 406 million, or this is, negative 406 million to 1.5 billion. So that's pretty good to see. Net income going from a loss to a very strong positive. And I think the reason why this was a big loss was the cost of the platform, and there was other costs involved as well that they put on that year earnings, if I'm not mistaken. Net cash provided by investing activities, negative 1 billion versus positive 115. Cash and cash equivalents grown. That's good. So nights and experience booked. I mean, they're definitely, I mean, they're growing at a very nice rate. They're definitely growing, they're definitely growing at a decent clip here.
It's not going to be the results of a major tech play. So, there's that as well. Nominal growth, steady growth is what matters, I feel, for a company like this.
Dude, look at this. So revenue was almost for September 30. Yeah, from September 30, 2022, revenue was almost pushing 3 billion, where 1.2 billion came to net income, which is strong. That's actually pretty strong. Adjusted EBITDA margins are 42 and 51%. That's phenomenal. So I'm actually surprised. I guess the only thing I would say is maybe people were banking on a little bit more growth on top line revenue growth. And, I'll have to dig through this a little bit more thoroughly. But I think top line revenue growth was probably going to be the big question. I'm actually surprised it's trading down, unless if there's something I'm kind of missing here.
It's a bit right now. You mean right now it's trading down?
Yeah, it was at 102 when it wasn't down.
I don't even think it's accurate to look at the market and make correlation.
It's coming back. It's coming back. Yeah, that makes sense to me. I figured it would come back a little bit. It'll probably get back to like 105, 106. But yeah, I mean, I don't see anything wrong with their revenue. I actually thought it would be up a slight percentage point here. Just the fact that, net income went from negative to a pretty strong positive, and their EBITDA margins are showing really strong strength. The only thing I can knock them on is stock-based compensation right off the bat, and just some basic dilution. But overall, did they beat? You said they beat, right? You looked it up.
They beat, yeah.
Yeah.
Look, I think they're in for, and I say this with a lot of companies, but it's just the facts. When an economic turnaround occurs, I mean, big names like this, just think about what people are going to be doing. I'm already planning a 6 to 7 months from now, a massive trip. I'm not staying in the Ritz-Carlton, right? It's where am I going to be staying? What websites am I going to be using?
Yeah.
And that's just paramount to start thinking about. What happens after we return to a healthier looking market?
Yeah.
We go back to old trends, old ways.
So I just to kind of go back, I actually have, I do want this stock to come down, because I roughly have about an $80 price target on Airbnb for me personally. So I'm not mad that this is selling off. I actually want it to go down a lot lower here. Because I do, we were talking earlier, Ari, right? We're talking about innovation and disruptive, right? The things that Kathy Wood loves. But guess what about this company? This company is innovative and fairly disruptive to the hotels sector. But guess what? This company has an ability to free cash flow like a mofo with 40 and 50% margins. So, that's why I like this company a lot. Now, is there anything proprietary about what they do? Not really. There's going to be other platforms out there that are going to try to steal business, but it's kind of like the Facebook model, where if they can get big enough, fast enough, they're going to have the, kind of have the ship.
They stole the show. They are the frontline leader here. When you think, at least when I do, right? When I go travel, I don't even know any other, similar. I'm thinking of like bed and breakfasts, but it's not an Airbnb.
Right. Yeah. And it's like, you can accommodate for a lot of different things. If you want to rent a room for $50 a night, you can find it. If you want to rent a house for $1,000 a night and throw a party, you can find it. So it's like the flexibility that it offers, hotels don't. And that's what I like about it. So depending on who the traveler is, like my girlfriend and I, we do tend to stay in hotels because the amenities.
I'm gonna make the correct fiance.
Oh yeah, hopefully she didn't hear me. No, but we tend to stay in hotels because when we travel to the Orlando area or the cities, it's just easier to be in the city, and it's harder to find Airbnbs. And then you get all the amenities with the hotels, and then she racks up hotel points, and we get benefits and all that kind of stuff. So. Yeah, so it just depends on what you want. But if I had family coming down, I would definitely do I would definitely do an Airbnb, longer term. So
Yeah, my family, my siblings took various trips throughout this past month, and they all used Airbnb. I don't know anybody who really is just flocking to the hotels. Although Bill Ackman was very aggressive with Hilton. He owns Hilton, right? But the major stakeholder rather of Hilton. But he's bullish, very bullish in Hilton.
yeah. Yeah, and I also got to say this: if you look at what Airbnb's done over the last 6 months or the last month or whatever, it's kind of went from like $100 up to like 120. So I mean, it's had a nice little run here. So it's for it to sell off a little bit. It's not anything crazy. And you know what? The other thing you have to take into consideration: these things could be selling off going into tomorrow anyway. You know
Yeah.
what I mean? Like that's the other thing we have to take in consideration, because if we look at what
Look,
stock
I'm
futures
waiting.
are
I'm
doing.
waiting for something to happen where Delta Airlines comes back down and lands on the runway for me to throw another. I think I'm going to probably put another 10 grand on the table and wait for it to pop back up. No basis really, other than it will fly again. That plane will take off, and then I'll just trade right out of the position. Now it's all in an IRA, so I'm just having fun with this. But it's similar to Airbnb in that when travel's coming back. It hasn't come back in full force.
Yeah. So it looks like dark matter is positioned both ways with the emphasis to the downside. So probably got some options going into, actually put it in the description. I'd be curious to know how you're playing this. You doing some sort of option straddles here with SPY, or are you doing the what is it, SPX or XPXU, where you're short in the ETF short? So curious to know that. Hawkish or dovish? We all kind of believe he's going to be. You think he's going to be hawkish. I
Look,
think he's going to be
I've been
fairly
calling
neutral.
this. I've been calling this for months and months, and everybody's like, "Hey, you're crazy." No, he's going to take it down a notch. I think the Federal Reserve gives us what we need weeks before they get into that blackout period of theirs. And Jerome Powell's a man of his word. He's going to come out, and I think he's going to be hawkish. It's going to be 75 basis points. That's what I'm putting my money on.
I
And
think here's
it's
where
a
I think he's
storm
going to
that's
throw
going to
you.
come
Here's where I think he's going to throw you for a loop. And I think there is a pivot coming by the. I
out.
think,
Should we bet a share of Meta?
dude, listen. By the time it happens, Meta's only going to be $50. So I'll just get you a gift card to like somewhere. No, listen. I think it's pretty clear that it's 75 basis points, and I think it's going to be 50 basis points in December, and I think it's going to be 25, and I think we're done. But I think he's going to signal possible pivot this meeting. I don't think it's going to be as hawkish as everybody thinks, because I think data is starting to come in soft now, and if he really wants a soft landing, I think he has to keep asset prices somewhat stabilized by being somewhat dovish, because the pain is going to come next year. And I think he knows this. Like, I think he has to find a way to keep kind of asset prices stabilized for the next few months. And the way he could do that is raise the 75 basis points, say, we're going to look at data. There's a good chance that, we will see what we do in December. But right now I don't think it's going to be like, we have to keep inflation under control. I don't think it's going to be that hawkish. If it is, I think we're in trouble. But I would say I think he's going to want to get some stabilization in asset prices, because the bond market's inverted. That he's got to be looking at this. He's got to be looking at the 3s to 10s. He's got to be looking at the 2s to 10s. He's got to be looking at the fact that, the market's down 19%, and it's probably going to go down back to 20, 25%. And does he really want to crush it that much? Or does he want to
He
stabilize it for
wants
when
a
the
soft landing in terms of hitting the mountaintop, right? That's what
Yeah, I
texted
loved
you.
when dude, I laughed so hard when you texted me that. You're like, yeah, soft landing by crashing into a mountaintop. Yeah, that's about as soft as it's gonna get.
That's what I think. I don't see us slowing down, and I'm prepared. I mean, I got, yes, my dividend investments, that's all vested, but I have 25,000 on the sideline ready for this, whatever's coming our way, soft landing on a mountaintop, right? Like,
Yeah,
I'm
I
ready
agree
for it.
with
I'm
you.
hoping for it.
I agree with you. But I tend to think that he's going to want to stabilize asset prices going into the election, going into the end of the year, and I think the true pain is going to come, unfortunately, end of year to the beginning of 2023 is when we're really going to start. But I think he's going to try to stabilize through November and as much as he can through December. But we'll see what happens. We'll see what happens. Maybe he's still going to be that hawkish, and I'm completely wrong. But I tend to believe that there's going to be a forced pivot here sooner than later because, when we look at the Fed funds rate trading, I think, what is it, right around 3.25%? And
I think, it's 3.2 at 3.25.
Yeah. And we basically need to get 4.5. So,
I think we could see it peak up to 5.
Yeah. I mean, we're basically chasing the 2-year treasury, so yeah, I mean, maybe it is another. So 75 would put us at 4. So we're about a half a basis. So I think my thesis makes sense that we see another 50. We see a 50
Look,
basis
we
point
may see
hike.
another 75 and then 25. What about that?
Yeah, that's
Right?
a possibility too. I think the faster we get to 4.5, I think 4.5 to 5, I think the better. But I do think he's going to try to stabilize till the end of the year. That's just my opinion because, it's going to be who's going to take the brunt of it all if we have a serious crash. It's going to be Biden's out of office. He sucks. And it really affects the elections.
I hate to get political, but I think this guy is well on his way out the door.
I'm not. I mean, I'm just saying, maybe somebody's trying to fight for him out there.
Spade. Like, go ahead, throw at me whatever you want. But I don't foresee a Democratic win come next election. I don't see the candidates' strengths there, but Biden doesn't have a shot. And I think he knows it. And I think the Democrats are already preparing for that, but they can't come out and say that.
Yeah. Yeah. I don't think so either.
And I don't have anything against Biden, right? We don't 100% align.
Doesn't sound like it.
Oh, the guy fell off his bike. No, no.
Man, there's definitely some crazy stuff.
We just don't align politically.
Nice guy. Nice guy.
nice guy.
I would go have a beer with him. For like 10 minutes and then I would be good.
And then go on a bike ride,
But the thing is you, in these times that we're in, you need absolute strength and leadership. You need, dude, what's going on in China, what's going on in Russia and Ukraine is unacceptable. True good leadership would have put their foot down, would have tried to pivot some things. And we haven't seen leadership in some time. And the lack of leadership has led to what we're dealing with today. We were going to deal with inflation regardless. That has nothing to do with Biden. I mean, yeah, maybe they made it worse. I don't think the student forgiveness plan would have helped at all. I mean, that's just more stimulus. That's just more people looking at the fact that they have no debt now. What are they going to go do? That money was spent anyway.
They're gonna take out their credit cards and go spend again somewhere else.
Because it's the mindset of I'm wealthier. I'm $10,000 wealthier now, so I'm gonna go get myself something.
Speaking of credit, it was interesting, and I shared this about a month ago. Now, every morning in the office, I'll do a roundup, and I talk about essentially where the market's at, where the market's going in the day, in the week. And forecasting really on a macro level for the month, what we could be expecting. Now, I had shared this thought where I was, saying if we are to get more talk of recession, this is going to scare the consumer. And should a recession hit as deeply as it may, even if the consumer is well capitalized, that will be, I think, drawn out of their bank account pretty quickly.
Yeah.
And what are they going to pull out? The spending's not going to stop, guys. The new iPhone's out. The spending's not going to stop. People buy off of emotions. They trade off of emotions. We live off of emotions. And so they're going to spend. And
so here's an interesting one. And I did a video on this a while back, but what we started noticing is that pension funds are using leveraged ETFs and leveraged, whether options or leveraged ETFs, to try to catch up to gains because people are living longer and they're underfunded. And with the underperformance of this market, it's going to be interesting to see what unfolds with these pension funds over the next year if we don't get some serious gains in this market. Because I think they're in
Look,
trouble.
we had a lot of retirees this last webinar that I hosted, and their big questions, of course, where do I put my money? What should I be looking at? How can I use the tools, right? The tip ranks tools for me at 60, at 65, at 70. And it's a scary time. I'm grateful that I'm young right now because it's an opportunity. But if you're nearing retirement, it's a totally different ballgame.
Yeah, honestly, dude. So I talked to my dad's girlfriend who sold his business. I said girlfriend again. Shit. I talked to my fiance's dad. So I worked in financial services, right?
We won't say anything.
Yeah. So I worked in financial services for 6 years, and I had to give financial advice, and was licensed, and now I'm not licensed, so I'm not as liable. You're actually more liable talking about finance on YouTube than when you're unlicensed. So because you're not considered a professional advocate for finances, you're just a
Which,
guy
by the way,
talking
none
on
of the
YouTube.
advice today was financial advice.
Yeah, none of this is financial advice. But
No.
listen to this, dude. Listen to this. So he sold his business and got a substantial amount of money. Now the problem becomes he has to supplement his money to create income to live off of. And he's not going to put it in the stock market right now.
Yeah.
So we talked about, rolling treasuries. I talked to him about, he like right now you're talking about getting 4.5%. I told him right now is probably the best bet to kind of just roll treasuries for the short term until we see who gets elected, what happens. At least you're getting some sort of interest. You're getting paid to wait, where before you weren't. And, before it would have been easy. You just dollar cost average into a bull market regardless, but I wouldn't recommend that for him right now. Because I think there's a good chance, I'm not saying a 50% chance, but I would say 20-30% chance that we could end up in some sort of secular bear market here where tech is an underperformer and they weigh the most on our retirement plans and they weigh the most on most indexes, and they could be an underperformer over the next 4 or 5 years if the feds don't pivot. If we're in a high interest rate market, right? If borrowing costs don't come down, the necessities of life are the only things that are going to perform well in this market. Utilities,
Jerome
staples.
Powell is giving me a great poker face. If you see it now, I'm just
You're like, whatever, I'm done.
Jerome Powell, the man's gonna come out. He's gonna. This is just we should bet on this, right, and have some fun with it.
Just throw some props out there.
He's going to come out and he's going to say what he's been saying, and they haven't changed their stance, and they're adamant. The market mandates are the most important. I think inflation and unemployment data. If we watch both of those data sets, it's going to give us everything we need to know about Jerome Powell's tone. And
so, but here's my argument, though, Ari. Here's my argument. So I agree, but if we don't have an accommodating Fed and we have high interest rates, that the only thing we can equate these rates to is 2008, like the speed at which they've moved and the hike at which they're at can only be equated to 2008, like in recent time. Okay. So we have rates that we've never seen, hikes that we've never seen. And what happens if the Fed decides to not accommodate over the next 3 or 4 years? Where are the markets then? If rates stay elevated, if inflation stays stickier than everybody thought, I'm not saying 4 and 5%, but like 3.5% inflation. That's still high. Okay. So if inflation
is not at 2% where the Fed wants it, but I mean,
right,
compared to 8%.
But I'm saying if that stays, if interest rates stay high, if inflation stays above 3%, and the Fed does not stimulate and or accommodate, what does the economy look like in 3 or 4 years? Because we only know an economy where the Fed's willing to dump money on a problem and lower interest rates.
Well, look, I think there's a few things that even went into play. I think the Federal Reserve had acted too late and did too little. And I think they're playing catch up right now. Now, in the near term, what I foresee happening is a hawkish stance. And you bear in mind, we have, I I think we're really looking for 2 to 3 months, right, worth of consecutive deflation for any type of real pivot in their hawkish stance. And until that happens, because the labor market is still incredibly resilient, it's very strong right now. And so with both of these data sets as they are, I just don't foresee. I don't even know if we can look ahead that far, because we're so right now in the near term of paying attention to inflation and unemployment. And if we're going to do these massive 75 basis point rate hikes, the time is now, when the labor market is as it is, so resilient. Now, again, gig work that's factored in there. So, I mean, there are other scary, like, gray areas, if you will. But the market could be in a very dangerous place either way. It could be red.
I tend to think that the market is in a dangerous place for an extended period of time.
For sure.
I don't know how long that is, but I just tend to believe, like, I'm looking at comments just now on people talking about, SoFi and the video I just did. And one person's like, $13 in 2030 for SoFi, like, question mark, like that's so disappointing. Yeah, the stock's at $5. So that means in the next 4 years or whatever it is, what are we in now? 7 years, you're going to over double your money. That's so disappointing. That's the type of mentality of the investors we're dealing with here.
Yeah.
Like, it's delusional.
Well, yeah,
It's
I mean,
delusional.
look,
What do you think it's going to do? You think it's going to go to 50, 60? You think, like, could it go to 50 or $60? Absolutely. But I'm trying to set a realistic guideline of, hey, if I think, if I'm going to buy a company like SoFi and take on risk, and I'm buying it around $5 and it ends up being a $13 stock, I've almost 3x my money in 8 years. That's a good investment. Like, what are we talking about here?
Like you always share, it's your brokerage account is the scoreboard.
Yeah.
But at the end of the day, $13 doesn't sound that sexy.
It doesn't. But if you bought it at $4 and $5 and you're up almost 200% in the position,
yeah,
not
I
bad.
Was fine with a 20% return on my Delta airline trade.
But that's what I'm saying. Like,
you have to be able to go to Vegas, put money on the table, make a return, and walk away. That's it. That's all. You have to just be able to realize your return, whether it's $13 or $9. It doesn't matter. You've made a return. Put more capital, perhaps put more capital in order to get more out.
Yeah, I mean, like, literally, if SoFi went from $5 to $7.50 in 2030, that's an average market return.
Yeah. But it's not sexy.
It's not. It's like, oh wait,
it's not
listen,
the palatable for sexy, right?
Yeah, if you want to buy something that's gonna, like, 6x, like, can it 6x? Yes, we don't have that. Nobody has that much vision into the future to know if a stock is gonna 10x. Nobody has that. Like, could it do it? Could there be opportunities that presented themselves in 3 years that nobody would have even imagined? Like, absolutely. But the problem is, everybody has this mindset. If I'm buying a stock for X amount of dollars, like, let's just say $10. If I'm buying a stock in $10, by 2030, it needs to be $100.
Yeah.
Like, no, by 2030, it could be a $17.50, $20 stock, and you've doubled your money. You've done very well over an extended period of time. You outperformed the market. And I think people forget about, like, 90% of people do not outperform the market. So when you're mad at me saying it's going to be a $13 stock, well, you just outperform the market. I'm basically saying there's a chance that you can do more than what 90% of people are not going to do, or something like that.
Can you drop your mic really quick? Can you just
drop the mic?
Yeah.
But like, isn't it true though? Like, am I like, seriously?
Oh, yeah.
People,
look,
like, become completely delusional about investing?
Yes. In layman's terms, yes. Look, the questions I received this is why I love doing them, these webinars, and you get a wide range of viewership, retirees to new investors, very delusional generation of investors. I agree.
Yeah, I mean, dark matter, like, stated it perfect. We are in such a delusional state of investing because of the last 2.5 years. it's unbelievable. Like, people are upset that
Well, everybody's a winner in a bull market, and that's when we saw that run up in 2020, and people thought this was going to last forever. And I was saying, just brace for impact because this thing is going to come falling down. And here we are.
yeah.
But again, this is opportunity for those who are able to put money in and wait, remain patient. The patience pays off, and that's the key. But yes, there's very delusional investors, and I don't think any of these newer applications that are out there from the Robinhoods and Webull and whatever new apps are there are helpful in any sense. I think it's time to remain cautious. I think it's time to understand that patience is necessary as an investor. As Buffett always shares, the stock market is a vehicle for transferring money from the impatient to the patient. Run with that.
Yeah, I mean, it's like, if you're building a portfolio, right? If you're building a portfolio, and let's just say you're in your first year and you're starting to build into positions. And by the way, that's the other thing we got to talk about, Ari, is, and I'm at fault for this too, where I'll try to time the perfect stock at the perfect price. Where it's like, I'll just go like you just said, I'll just dump 10 grand into Delta right away, when I should probably be like, all right, over the next 6 months, I'm going to put, $700-800 a week into Delta until I'm averaged in, or even over a year, I might do it. Right. And because we don't know where the bottom is, we don't know how bad it can get. Like, the prices can get so disconnected that it's never smart just to lump sum and try to time your stock.
I don't typically do that.
Yeah.
I
Way to promote gambling on my channel. Why don't you just go to the casino, bro? Why don't you just go to the casino?
I wish I was on Tom Nash's channel. But look, at the end of the day, I don't normally do that. The reason I did that was because Hurricane Ian hit, and all the airlines were then backed up, delayed, and the stock share prices came down. Now, I just went ahead to understand that this is all emotions at play for airline stocks. This has nothing to do with their fundamentals and their spread. So threw money in. 3 weeks later, they're back up, and I sold, walked away with 20%.
Yeah, I mean, I don't personally want to own airlines I don't see, it's just a bad business right now. They're a necessity of life, but the margins are awful. There's so many question marks. Competition is a problem. There's just too many things I don't like about them. There's not a clear-cut, concise winner in the airline market that I really can say this is the one. They're going to take it. Like, the margins are so slim. Fuel costs are always a problem. Seasonality is always a problem. Maintenance is always a problem. The CapEx is just a lot of things about airlines I personally don't like. If they can figure some of that stuff out, maybe I'd be a little bit more interested in them. But yeah,
I just use them to swing. I mean, I'll jump in when there's a lot of emotions at play, and
yeah. So he's saying Jets ETF is the way to go if you want to do airlines. Which, I mean, that's just going to be the well diversified, ETF of airlines, and it's going to trade with them. I mean, so, from a beta standpoint, it makes a lot of sense probably because the ups and downs, you probably catch a little bit less of the downside, but catch enough of the upside to cash in on it. So that's a good call.
I'm never long on airlines. Again, this was totally just a quick, jump in. It was done in my IRA, so I see the profits. I play with Uncle Sam there and not having to divvy up the tax money. So it was just an opportunity. But this is
wait. I got a question for you, and I got a question because I do this question last time.
Yeah.
Okay,
I like the excitement. Go ahead.
All right, ready? One stock you buy today at the close, what stock is it? And guys, if you're in the chat, one stock you would buy today at the closing price today.
Can I take a look? Can I use
my phone? Everybody can take a quick look. I'm going to shrink myself down and take a quick scan here. All right, so whatever closed today, what would you buy? What would you buy
at the closing price?
The closing price today.
Google. Is this like all in? Like
This is
Oh,
like your
no. I'm just saying, like, what
just a
stock would
chunk of
you
cash.
what stock would you buy right now if you could go all like if what at the close, what stock would you be buying if you had like 10? If I gave you 10 grand and said you have to pick one stock right now, what stock would it be?
Google.
That's a good one, man. I'm not gonna lie.
I mean, look, I liked it at 97. I liked
It's
it
at $90 right now.
yeah, it's at $90. This is unbelievable.
Dude, I might buy it right now. What the? Oh man, where did Amazon close?
I actually may, I'm going to do this right now. Right, I'm going to live. I'm going to buy some Google. I am a man of my word. Put my
He's
money where
buying
my
Google. I like it, man. I think Google's a great call.
It's
I think
fantastic.
Google's somebody's got Intel. Dark Matter's got Intel. Dark Matter, have you been listening to our show today? Jesus. No, I'm just joking. I understand the value play on Intel, but man.
Dark Matter, you got 4 minutes to throw cash in there. Intel, how much are you putting in?
Should we buy Google? Laugh out loud. No, it's not a recommendation.
This is not stock advice. I am just investing in Google as we speak.
Man. I'm actually having a hard time here because I like Google at 90, but I also like Amazon at these levels. I technically would like I think VOO would be an interesting buy because the top holdings are all sold off really hard. Minus Apple. So when we look at the top holdings of VOO, Microsoft, Amazon, Facebook, and Google and Apple are the top holdings. All those companies have sold off so hard. It's almost. I kind of want a ETF that has Amazon or Google as the top holding. All of them have Apple as a top holding, of course.
I'm just buying too. My portfolio now has 40 total shares of Google.
That's a pretty good holding.
Because look, it may come down a bit more.
I think I'm leaning towards Amazon if I can't find.
Here we go. There it is. I don't want anybody calling me out that I'm not a man of my word.
Dude, let me make it bigger. I'll make it bigger. Just make sure you hide your. Look at this guy.
What are you going to steal? Go ahead.
He's buying Google right on the spot. I friggin' love it. Dude, that's awesome.
Look, it's $90 a share. I mean, this is a steal. And I got Dark Matter over here. What are you buying in Intel? How much are you putting in?
Why are you buying Intel? No, I'm just joking.
I'm just jazzed up right now. I want people to buy. Everybody's got 2 minutes. Put your money where your mouth is. It's a share. It's 2 shares, whatever it may be.
All right, you're promoting investing.
I got a wedding
gift. This is not investment advice, guys.
This is not investment advice. This is me going insane. I'm trying to pay for a wedding gift for a friend's wedding coming up in Disney.
You don't have to. I was like, you don't have to get me anything.
Of course I am. Why wouldn't I?
No.
For you and your girlfriend.
I'm surprised. You know what I'm surprised is nobody actually picked Baba. That surprises me a little bit.
You know, I did. This was great. All the Chinese stocks fell, and I tweeted immediately. Psychology tells me that these stocks are going to soar right back up. And like 2 days later, they all flew right back up. And my only thought was, I should have put, $5,000 or something into. I like JD.com, but into JD or Baba or one of these because it was just an emotional day. The elections over in China. Could have made money.
I'm thinking.
Did anybody else commit? Did anybody else actually buy stocks?
All right. You want me to do it? Is that what you're
I
trying to
want
do?
I want you, I want this
are
on
you,
the screen.
are you trying to get me peer pressure here?
Are you going to do it or not?
I think I'm gonna buy some Amazon right now. Even though,
Amazon. Do I still have time?
but the thing is, I can buy after hours. But the thing is, I think Amazon's gonna get to $85, so that's why I'm hesitant.
Well, look,
I think
mark my
I think it
words.
breaks. I think it breaks down.
Mark, I think it will as well. Mark my words here again, and we can live stream again, and I'll do more on the spot buying. I think Google will come down a little bit more.
I think this is good. I think we should do on the spot buying
On the
because,
spot buying, it's exciting.
dude, but I do have a lot of price targets that are getting close, and I want to be patient and wait for them. Like Amazon, I do. You can look at my last video. Amazon, I said if it breaks below 102, I think the next line of support is between $80 and $85, and I'm willing to buy 100 shares at between $80 and $85. So
Look, Google falls below $90. I'm going in a little bit more, but I think we could see Google really come down. It's really dependent again on the tone of Jerome Powell. This will be huge, but if Google hits anywhere around $80 per share, I'm jacking my portfolio up to maybe 50, 60 shares worth of Google.
are you kicking yourself in the butt right now that you just bought right before the Feds are going to speak?
No.
You're like, oh shit.
No, because
yeah, I've done that before. I totally have been like, all right, this stock's so cheap, I'm gonna buy it right now. And then the next day it's the Feds are speaking. I'm like, I totally forgot. Oh my God. Like,
no, I know the Feds are speaking
no,
tomorrow.
I know.
And the thing is this, in the slight chance that I'm wrong, I'm still right because I bought Google.
Yeah.
I'm gonna dollar.
You're holding it. Yeah, you're holding it forever. And I look at Amazon as possibly one of the most important companies in the world. And it's at an interesting price point.
3 letters for you. AWS.
Yeah.
Massive. And it's not even just based on, I did a very rough, right? Hands up in a Zoom room type of, questionnaire.
All right. So actually, we talked about Facebook early in the live stream, and I'll just going to run through it just in case we got new people here. But so Facebook to me is, if you think Meta is going to amount to anything, like anything substantial, it is an absolute steal at these prices. If you think that this is being money lit on fire, then with that being said, like, I think you can wait a little bit longer on Meta. I don't think much longer, but I think you could wait a little bit longer on Meta. But it's more of a time thing than anything, because trading with the dummy, I think what you have to take in consideration is they're not slowing down on spending. So the next quarterly report, is the stock going to be down another 10 or 15% because of that? And so I think that would be the opportunity, because you're getting closer to them possibly building out the metaverse and maybe looking at kind of shifting their thesis to maybe not spending as much because people are jumping ship on the company. But right now, I would say I think you can wait a little bit. I don't think there's going to be any catalyst in the next quarter that's going to force Meta to go nuts. All we know is that they're spending, and it's kind of impacting the free cash flow of the company. But I'm not disappointed. I would say, yeah, absolutely, you could look at Meta as an absolute buy at these levels.
Let's ask this. I'm curious. Trading with the dummy. What are you doing with Meta? Are you buying? Are you in? Are you out? Do you love these prices? Are you joining Mark Zuckerberg on the ship towards the Meta universe, or is he a lone sailor?
Let's see.
Interesting.
Yeah. So he's bringing up kind of like the point that we were talking about before is, I don't think we talked about it today, but it's the training aspect of the metaverse that also, that we have to think about, like NFL players that are injured, being able to practice like they're on the field, athletes being able to kind of like do that in general. Race car drivers, pilots, anything, truck drivers. So there's a whole training platform. Like, look at dude, we didn't even bring this up. Let's say that you're going to trucking school. what is more cost efficient, right? Using something like the metaverse to train truckers on driving, or actually taking, $150,000 vehicle out on the road and hopefully nobody crashes the damn thing. Like, you know what I mean? Like, there's things out there that, like, the metaverse makes a lot of sense. It's just, in order for it to pay off, I think it has to appeal to the masses. And that's the big question that everybody has, is how is it going to appeal to the masses? And so, but I think he brings up a great point. Metaverse should be.
Look, I think there's something there. I don't know what exactly it is, but there's something there. And I think Zuckerberg's got stones. And, even though Kramer came out and apologized, I don't think he should have. I think he should hold true to if that's what he truly believes, that there's something there. Trust your management, trust your leaders, and double down in the trenches with them. I mean, I'm not afraid to say it, that I think Zuckerberg is up to something, and I think it's going to be a game changer. I just don't know.
But he doesn't. Here's the thing. He doesn't have to be right about the metaverse. Like, that's what people are missing. The minute he stops spending, the stock is trading at a 3 PE ratio.
Yeah.
Like, honestly, the recent sell-off you're talking
about. Is it right now at a 3? Is that?
No, it's at like a 7. But I'm just saying, like, if he turns off the spending and invest in some of the other assets, the 90 other assets that he has within his company, and boosts them up a little bit and grows their top line instead of building out the meta, it literally would be trading, I guarantee, a reversal of conditions, and we get ad spending back up. It would be trading at like a 2 or 3 PE ratio. Like, that's how crazy it is.
I don't disagree with this. FOMO tells me the dollar cost average these prices, but I think there will be still more several bad quarters. I am in line with that. If you believe that Meta is going to be something big, then I'm in line with that. And if it meets your investment criteria and suitable for your investment portfolios.
All right, wait, I got one for you. So, trading with a dummy. Ari is a value investor who's a dividend investor. So now I got a question for him. Ready?
I do.
Ari.
I can imagine.
Ari, wait.
Yep.
Wait.
Oh,
no,
I'm
asking you. Yeah, no, I know I pulled that up, but I'm asking you.
Oh, okay. I was like, that's not what the question says.
Meta spends half on metaverse and creates a dividend with the other half at 3.5%. Are you buying? Boom! Got him. What are you gonna do? Listen, what are you gonna do if they're like, you know what, we want to pay the shareholders that have stuck with us, and we're gonna incorporate a 3% dividend, 4% dividend yield, and we're only going to spend, $2 billion a quarter on metaverse because they got a good jump on it. What are you doing then?
Look, I think I'm gonna answer.
That's a good question, dude.
It's a great question, and here's the thing. It comes down to that. There are very few men in this world whom I really respect and admire. Like,
right? That means a lot to me.
You're one of them. You are. But what I will say is this: when I look at a leader with guys who have trailblazed industries, the question becomes for me, would I trust this person if I gave him money and they didn't expect anything in return to make something happen? And that pushes me in the direction of I would invest. Of course, I'm not going to invest everything into it because it's not how I, work my portfolio. But I do respect Mark Zuckerberg, and for all the heat that he's getting, and to continue in the direction that he's continuing in, that really shows me something valuable as a leader, like man to man, leader to leader. When you have a vision and you go for it, I can respect that. And it may totally flop, but at the end of the day, the vision is there. And his leadership abilities have been there, and they're still there despite what people are saying. They are still there. This is what a visionary does. He fights against the grain. I mean, I've said this before earlier, early 2000s, folks, before Facebook was Facebook and Mr. Tom was head of MySpace, right?
Mr. Tom.
Zuckerberg.
It was the only friend I had on MySpace.
He was in my top 3, top 4. Zuckerberg was the guy that we had that came out of left field. There was no media attention. There was no spotlight on him. People didn't know his name. They didn't know anything about him. He came out of left field. He lit up the industry, trailblazing it. And here we have still today exactly that happening, but he's not making the investment decisions, the safe investment decisions that people want him to, burning that cash. People get worried. Sometimes you have to go out of your lane in order to make something new happen.
Yeah. No, I agree. But the
Imagine
problem,
if Google begins a dividend, game over. I will
Google
throw
begins
tens of thousands.
a dividend. Google begins a dividend. I don't know. Maybe I'll buy. But
Oh, now we've convinced.
I like Google. I like Google, but if I were to say right now, if we head into some sort of deep recession, okay, Amazon will outperform Google in my opinion because of ad revenue versus necessities of life. And that's just my opinion. I think that Amazon will, once Amazon finds a bottom, once Google finds a bottom, once all these stocks kind of find the bottom, I think the outperformer, if we go into recession, is going to be Walmart. It's going to be Amazon. It's going to be your defensive plays. And I tend to think that Google still has a little bit more downside with the risk of ad spending coming to kind of a standstill question. So, that's why I would say I'm leaning more towards Amazon. But with that being said, the multiple for Amazon is ridiculous. But we also have to factor in that the growth rate is still remaining elevated, so you're paying a premium for a pretty good growth rate that's shown consistency.
Man, I would love for all of these companies to come out with a dividend. If Amazon had a dividend, if Google had a dividend, I would be all over them. I mean, I'm all over Apple and the dividends that
Haynes play.
64?
It's my Haynes play. I was like, my Haynes socks and underwear, man. I was like, retail is taking a crap, and I'm like, Haynes is interesting. Like, are people really going to stop buying socks and underwear at a reasonable price? I don't know, maybe.
My sister took a trip to the United States and came back and delivered some socks to me. I'm not going to stop buying. Who's going to stop buying underwear and socks, right?
Yeah.
Socks by the dozens over here, new. And on top of that, I think a great opportunity right now is VF Corporation. Fantastic.
I know they're a good company. And they've been beaten up.
Do you own a pair of Vans?
Not anymore. I've had some in the past. But no.
I got sleek white Vans over here. I buy like one new pair of shoes every year, right? Just once a year. Hopefully they last me for a decade. They never do, but Vans, white, sleek, Timberland, JanSport. These are great companies.
I missed so trading with the dummies, bringing up a good point. These are more your defensive plays, like your Hershey's, your Twinkies, WWE's at the World Wrestling. Is that the World Wrestling
WWE? That's what I think of. What ticker is that?
Yeah, World Wrestling Entertainment. So
is that a thing?
Yeah, they're a publicly traded company. It's actually been very stable.
Wow, I didn't even.
It was trading a year ago. It was at $49. It's at $78 right now. But he brings up a good point.
Popular still.
I'll tell you one that I've been keeping an eye on, but that is Budweiser. And unfortunately, I thought they were going to miss earnings, and I've been waiting on them to get in the 30s. It jumped up to $51, but this one has been beaten up. It was at $67, and this is one that I think it had supply chain issues. It had some other problems, but this was $111 stock like 5 years ago, and it's at $60. And when you look at the financials, they've done nothing but grow their top line from $54 billion to $56 billion over the last couple of years. They took away their dividend through the pandemic, and this is one that has a hell of a portfolio. I mean, it's the king of beer. And it's like when you think about recession and people staying home, I think you're going to see an uptick in a lot of these types of, kind of companies here that are, people are entertaining themselves. So this is one that I've been keeping an eye on, but it has to get to the right price because the valuation's a little high on it. In my opinion, it's trading for a 20 PE ratio. But the market cap is at $100 billion, and you're talking about the king of beer, with a ton of of other assets in their pipeline.
Look, you can start talking about sin stocks for a recession, and they're great plays. I don't invest in them, but I took some heat for mentioning a sin stock on my channel. Question for everyone.
You want to tackle that one first?
Yeah, sure. Okay, so I'm gonna hit the last piece of this question. How about an everything bubble? I think we already experienced that in 2020, and I think what we're seeing now is actually we're trying to understand, based on this economic backdrop that we have, where the true valuations of these companies really are and where they're going. And I also think there's a lot of change happening right now that I don't think a lot of people are factoring in. Meta is a great example, but like, think about just the shifts that are happening. Google is focusing more on cloud, right? Microsoft.
Meta's getting into virtual reality now.
Yeah, Apple as well. So I think there's a shift happening here, and I think we're trying now to just evaluate where a lot of these companies are actually heading with these ideas and how much their true valuations could be. Now, I think there's going to be a new tech bubble crash, not necessarily not with these big companies. Meta might be the closest that we'd get to one.
So, all right, I'm gonna throw out some facts here, because I think this is a really, really good question. I think it deserves some thought. And like, get this, okay? Over the last year, some oil companies are cash flowing better than Apple, than Microsoft, than Google, and they're trading for half the price to earnings value. They're trading for half the valuation, but are cash flowing more. So I think what we're seeing is a repricing in stocks across the board. And what's happening is tech was what led us over the last 10 years into this massive bull market. They've been the most innovative companies. But what we're seeing is we have an economic slowdown. So what happens with economic slowdowns is innovation becomes a little bit harder and harder and harder, because the consumer is a little bit more stretched. So what we're starting to see a shift in spending from goods, which would be kind of a lot of your tech companies, like the iPhones, the tablets, the new vehicle, like that kind of stuff. And we're starting to see it into goods and services, because that's what's important to the consumer right now. And so there's a whole repricing in the market. And when we factor in higher interest rates, right? Higher interest rates do not bode well for high multiples, and does not usually bode well for the tech sector, because the tech sector usually is good at borrowing cheap and being able to get a good return on those assets. So that's kind of out of their pocket. What people don't understand is a lot of tech companies make a lot of money on return on assets. So when they take money, they usually do a very good job of earning 20 and 30% and borrowing at 5%. And that comes through on their bottom line. That equation is now going away from a lot of these tech companies. So in my opinion, you're going to see earnings come down in a lot of techs, not only because we have a strong dollar, not only because we have a consumer slowing down, but because the cost of money is going up. That is kind of the ace that they don't have in their back pocket now, which now brings forth your Coca-Colas, your Johnson & Johnsons, the companies that we need on a daily basis that just chug along and keep up with inflation and outperform a little bit at a time. And it's the necessities of life. So that's just my opinion. And then the reason why I heard that today about a lot of these oil companies are actually cash flowing stronger than a lot of your tech companies, but they're still trading, even with the huge run up that they have, they're still trading at very depressed valuations comparative to other companies that are free cash flowing about the same.
I think it's a great analysis. It's worth, again, energy in the last year or two has been big investment. And I think a lot of investors who've been flocking away from big tech, they're going somewhere else. And a lot has been poured into the energy sector. And I also think, interestingly, we're looking at a lot of now new green energy plays that are coming about. Even like an ExxonMobil, you wouldn't necessarily think that's a green energy pick, but
they're spending
they're spending a whole heck of a lot. So there's a lot of innovation on the line across the board for every industry.
Yeah. Yeah, it's definitely, there's a lot of shifting going on here, especially when we factor in higher interest rates. And that's why I was saying before, Ari, like, what if interest rates remain elevated? What if the new norm 5 years from today, after this live stream, that 7% interest rates for a house, 8% interest rates for a house is now the new norm, right? Like, it's going to take us a while to really, it's a U-shaped recovery at that point. It's not a V-shaped recovery. Like, it's going to take us a while to get through a recession. It's going to take us a while to get used to paying
Might be
more for
more like
stuff.
a U-boat, right?
Yeah, it's just going to be, it's probably
A
going to just
really
be a flat
long-
line. It's going to be a flat line. Just like, seriously, it's just going to be like
Look,
done.
I think we're going to have inflated interest rates for a prolonged period of time. That's what I foresee. And I think we should get used to the higher inflation for a prolonged period of time. That's just my 2 cents when it comes to the Federal Reserve, their chess moves, and what we could be seeing, higher mortgage rates. Sure. Yeah, I can see it. I don't think we're heading into any pretty picture anytime soon.
Yeah, trading with the dummy, saying the S&P increased holdings of energy. And I mean, that's the reason, like, this has been a really controlled crash, correction, whatever you want to call it. It hasn't been like, we're talking about 12 months of negative 19, 20, between negative 19 to 25% returns. 12 months. That is like beat you up, exhausting, sucks. Where do you go? How do you invest?
If you're not a contrarian investor, right?
Right. But I'm saying, like,
I'm sitting here with a cup of tea every night saying this is amazing.
But Ari, let's talk about the average person right now, right? That's invested in the S&P 500.
It's not me with my mindset. Yeah.
But let's cater to the person that works the 9 to 5 and is dollar cost averaging into that right now.
Well, we can even talk about
every day, every week, 20% of their check is getting less. Like, every week it's going down every week.
Okay,
that gets frustrating when you're a newer investor. When you're
a lot of companies just had layoff and like more rounds of layoffs. Now, something that I've heard quite a lot, whether it's at work or on the YouTube communities or just friends, I don't have the money to invest. And that one's a killer, because then you hear recession and they're like, I'm never going to have the money to invest. And I just want to make a point, guys, that it's like, you show me your budget, you show me how much you're making. When I lived in Manhattan working for a real estate firm, there was a gentleman who worked in our mail room. And one day I walked in to go mail something out. He stamps it and he goes, "You mind if I ask you a question?" I said, "Shoot." And he goes, "I have X amount in debt. I have 2 kids and I'm panicking because I just feel like I'm never going to be able to invest." I sat down with this individual and we literally mapped out a plan, not only to get out of debt, but how to start investing, even if it's with a measly $5 to $10. Stop with your Dunkin' Donuts and your Starbucks. Go buy coffee beans, grind them up. I get frustrated because people tell me they can't invest. And then I look at what they spend money on and I say, you can invest. You're choosing not to. Yeah. And you can start to take a look at that. And that $5 investment a week, a day, if you can make that Starbucks coffee happen every day, you can make it happen every week. Now you're investing at least $10. It may not be colossal amount of money coming in, right? But over the long span of time, you're going to be in a far off better position than if you just keep buying those Starbucks coffees. Your Starbucks coffees, I'm not talking about you, Colton, but your Starbucks coffees.
I make them at home now.
I'm reluctant to share all this because everybody buying Starbucks coffee is paying me my dividends. So thank you, number one. But number two, please understand that you can invest. It's just an understanding of having a very simple budget and investing. Invest. Please invest. Yeah. This is the time to do it.
Shout out to Trading with the Dummy. He's heading out and he's I'm on here shortly, so I guess he might.
I guess we're coming to your channel then. That's,
yeah, we'll swing by and pop some questions in there for you, but yeah, I think you make a great point. It starts with the plan. If you don't have a plan, you have a problem. And whether your plan is, I'm just going to dollar cost average, I'm going to dollar cost average into a couple indexes. And when the market's down 20%, I'm going to double that dollar cost and be ready to do so. Or I'm just going to not look and just put X amount in every week, every month, whatever. Or if your plan is as a dividend investor, and listen, dividend investors do get a lot of flack because the whole thing about dividends is it's not the best way to return capital to investors. But that's okay. It doesn't need to be, because you're showing that if you have a plan, it doesn't matter. You stick to your plan, you stick to your principles, the outcome's still going to be the same. The thing I do like about dividends that doesn't get a lot of recognition is, especially if you're using dividends into a tax efficient account, is the predictability of dividend kings. Yeah, it's 3.5%, 4%. Some are probably paying more now that they've dipped. And as long as the payout ratio is still good, you could probably still, you don't want to rely on them, but you could probably still count on those dividends. It's the predictability of knowing, even in a bad market, I know I'm getting a capital appreciation of 5%, or some sort of cash flow within my portfolio, regardless of what the market's doing. So yep. I do like dividends as well. That's why when you made funny about Gilead, that thing was almost a 5% yield, safe 5% yield with great stuff in its pipeline. It had too many things about it that I like, too many characteristics.
Look, I've had one goal since our first phone call, and that was to create a new dividend investor. And I think tonight, folks, we have succeeded in creating a new dividend investor. Financially Fit goes dividend.
But okay, so here's one thing I will say. But you just bought Google, and Google doesn't pay a dividend.
I know. Okay. Google is one of 3 stocks. You cut me slack, all right?
But listen, Ari, there's still I understand the dividend side of it. Totally get it. But there's still, you got to look at it from a growth trajectory. What can grow, what has big opportunities. If it pays a dividend, that's just a bonus to me. That's just icing on the cake. If I have 2 stocks that I'm looking at, right? And they both have decent growth rates. They both have X, Y, and Z. But one pays a dividend. I'm probably going to lean towards the dividend if I feel like they both have a substantial amount of upside. Just because I'm basically building a little bit of safety in there that, hey, this company has proven a track record of being fiscally responsible and returning capital to investors. So there is that. But
look, moreover, I think when it comes to dividend, it's like your sprinkles or your icing, on top, just like you shared. It's an added bonus. I like the companies. My father was an executive at Johnson & Johnson at one point.
Oh, I didn't know that.
Yeah. Oh, yeah, he was. Oh, yeah.
Dude, I knew you had a soft spot for Johnson & Johnson, and I was like, why does he have such a soft spot for Johnson & Johnson?
I love me some J&J. No. So it was so simple to me. Growing up, my dad had always shared with me, you really want to invest in healthcare opportunities. And when I would question that advice, he would share that healthcare is something that no matter where the market is, everybody wants to live longer. Everybody needs to be healthy.
Yeah.
Done.
Yeah.
And so from there, it's just
no-brainer.
Figuring out what healthcare companies are leading in X, Y, and Z areas and go for them. And Johnson, just watched my father's portfolio just with J&J, his stock options, the whole thing.
Yeah. Yeah.
Made a hefty
compounding interest. And he got in early, and he just kept with it. And he's right. You don't have to overthink certain healthcare stocks, right? You have to overthink Facebook or Meta, because it's are they going to be a necessity of life? Is Meta going to pan out? I don't know. Healthcare, it's are we going to need more hospitals? Are we going to need more cures for X, Y, and Z? Probably. Little bit more predictable, a little bit more of a necessity. But
and by the way, I like that they actually rolled out their consumer goods segment. It puts a very heavy emphasis on the 2 things. My father worked in medical devices. He's the medical device king, right? But I share this. I think this is going to do great for Johnson & Johnson's name, because consumer goods took a large amount of the heat when it came in from baby powder, right? And all the court cases, nominal negative news attention when it comes to medical devices and pharmaceuticals, though they did stop with their vaccines, but I think that was also a wise move. I think Moderna and Pfizer had that covered, and J&J was blowing money they didn't need to. And I like 6 months ago, there I was, buy Johnson & Johnson. Everybody's freaking out saying, nah, I don't know about that one. And now I'm sitting pretty on, I think it's at $173 per share right now.
It popped pretty well over the last few months.
It certainly did.
And they're going to grow their dividend, so you just got the double whammy there of capital appreciation with dividend growth. So that's a nice rate of return. But
I'm gonna sleep well tonight.
But anyway, I'm gonna sign us off here if you're cool with that. We're going on 2 hours and 10 minutes, man. You were like, yeah,
I came on fired up. I came on ready.
You did. Just so everybody knows, Ari's like, yeah, let's just go on there really quick. I'm all fired up. We'll do like a short one. And I'm like looking, and I'm like, it's 2 hours, man.
Here's the shtick, man. I pushed this thing back and then requested forward. And personal full disclosure, guys, I'm going to sleep a wealthy man tonight. I got great investments. My portfolio, yeah, it's down, but I'm very confident it's going to do amazing in the next 6 months, a year, and it's going to return me well over the course of time. I got a date tomorrow.
Whoa, that's right.
I'm $1 million, baby. I'm $1 million.
You're rich right now. You're feeling really good. Just, hey, don't take her anywhere too nice,
No. I mean, look,
save some money, cook in the apartment. That's a little creepy on the first date.
That's a weird. I can't do it. No, she's the queen. That's it. She's beautiful, amazing, and I'm very wealthy. I'm a lucky man. You are wealthy. You are getting married soon. You will have a nice meta wedding gift from me.
I love it. I love it.
Carl's just jumping on. Should we go for another hour?
Yeah, I wish, Carl. Carl, you missed a lot, man, but that's all right. You get us on the next one. We'll try to give you guys some more notice next time. This was kind of a quick throw together here, but yeah, Ari, we'll plan another live stream in the next week or so, maybe towards the end of this week, depending on what's going on. But
sure, guys, I'd love to drop this in there for everybody now. Again, Colton has an amazing platform that he's now marketing for, which is incredible. Tip Ranks. Head to the description there.
Go to the description.
Jump on the Tip Ranks. Use the tools. On top of that, guys, subscribe to our channels if you haven't already.
Yeah, if you're not subscribed, I don't know what you're doing with your life, but
yeah, I have zero clue because look at us.
I think we talked some, I think we brought up some great points, and a lot of people in here brought up some great points, and it was it was a good discussion for everybody, especially going into the Fed's meeting tomorrow,
We also want more, though. We want more participation. If you guys got questions, we got answers. And
or at least we'll try to have answers, but
yeah, we'll try our best.
Yeah.
But we'll give you something. We'll give
you an answer. Might not be right, but we'll give you something. But anyway, guys, really appreciate it, everybody. Get the link in the description and get on Tip Ranks. It is a really, really helpful tool. I'm really starting to see the insider moves. Makes me wonder, why they're doing it. They usually have a heads up before anybody else does. So see what professional money's doing before you decide to make your own decisions as well. Might help you kind of get that conviction you need to enter certain positions as well. But as always, guys, really appreciate your time. And Ari, it's been a pleasure, man. We're going to sign off, and we will see you next time, investors.
Grateful to be on here. Take it easy, everybody.